What you're about to hear is not speculation. It's not a rumor. And it's not something you'll hear on mainstream financial news. Because buried inside one of the most violent silver crashes in modern history, there was a signal, a leak, and it came from the last institution you would ever expect, JPMorgan Chase. On January 30th, 2026, silver experienced a historic collapse, a 35% intraday crash, the worst single-day move in 46 years, from triple digits to $75 in hours. The markets were calling it chaos. Analysts called it a reset. Retail investors called it a massacre. But beneath the panic, beneath the forced liquidations, something very different was happening. Because while everyone else was being liquidated, JPMorgan was buying, not guessing, not reacting, but executing with surgical precision. At the exact low, the trade that shouldn't exist. Let's start with the data. During the crash, at the precise bottom near 75 an ounce, JPMorgan quietly closed 1,959 silver short contracts. Not near the low, not after the bounce, at the low. Think about that. In the middle of the most violent silver collapse in nearly half a century. The largest, most sophisticated precious metals desk on the planet somehow knew exactly where the floor was. That's not luck. That's not coincidence. That's information. And here's why this matters. If JPMorgan believed silver was going lower, they would have held their shorts. If they believed the crash had more downside, they would have pressed the trade. Instead, they did the opposite. They covered fully, decisively. That single action tells us something massive. It tells us the suppression campaign just ended. Why this was a desperate attempt. To understand why this moment is so important, you need to understand what January 30th actually was. This wasn't a normal sell-off. This wasn't profit-taking. This was a Hail Mary. For 9 straight months, silver had been climbing. Month after month. Higher highs, higher lows. Even after pullbacks, the trend never broke. By late January, silver had gone vertical, up over 60% in a single month. That kind of move threatened systems, not portfolios, systems. Because exploding silver prices expose the weakness of paper money. They expose leverage. They expose synthetic supply. And most importantly, they expose short positions that cannot be closed without breaking the market. January 30th was the moment those shorts made one last stand. The paper slam. The crash was driven almost entirely by paper selling. Futures contracts, derivatives, synthetic silver, not physical metal. In fact, here's the key contradiction. The day before the crash, January 29th, silver was still trading near $117 an ounce. And that's when something extraordinary happened. The Perth Mint suspended sales, not because demand collapsed, but because demand was overwhelming. They began rationing supply. Let that sink in. At $117 silver, the physical market was already breaking. So what happens when paper silver is slammed down to $75? Demand doesn't disappear. It explodes. That's why this crash didn't fix anything. It exposed everything. The system cracks. Now here's where the story takes a darker turn. According to an anonymous but reportedly high-level Federal Reserve source, the silver crash triggered something far more serious than investor losses. A bank, insolvent, completely liquidated, not stressed, not at risk, gone. The source claims the exposure could be 100 times deeper than 2008, and the implication is chilling. A major silver short, likely leveraged far beyond reason, was caught when the price did not continue collapsing. The moment silver held $75, the trade broke, and so did the institution behind it. That's why JPMorgan covered. They weren't reacting to price. They were reacting to systemic failure. Why the crash failed. Here's the part that most people missed. Despite the biggest intraday crash in decades, silver still closed January up 19%. Let that sink in. After a historic slam, after forced liquidations, after panic selling, silver still finished the month higher. That was the 9th consecutive monthly gain. That's not a broken bull market. That's a bull market that refused to die. The physical market didn't blink. The Perth Mint didn't magically refill supply. China didn't dump metal. The paper market flinched. Reality did not. And JPMorgan knows the difference. What this signals. By covering shorts at the exact bottom, JPMorgan effectively told the market, this is as far as it goes. When the biggest player exits a suppression trade, it's not because they lost control. It's because the trade is no longer survivable. The system ran into an immovable object, physical scarcity. And once that happens, the rules change. This crash wasn't the end of the silver bull market. It was the moment the paper illusion snapped. And what comes next is not quiet. Now, here's the part that almost nobody's prepared for. When a paper market breaks against physical reality, it does not heal slowly. It snaps violently. What you just witnessed on January 30th wasn't the collapse of silver. It was the collapse of confidence in the paper system. And when that confidence breaks, price discovery doesn't drift, it reprices. Why the bottom is already in. Let's be very clear about something. Markets do not put in perfect bottoms by accident, and institutions do not cover massive short positions unless the risk profile has inverted. JPMorgan didn't close shorts because silver looked cheap. They closed because silver became dangerous. Dangerous to stay short, dangerous to fight physical demand, dangerous to remain exposed when vaults are thin and deliveries are being questioned. This is why the $75 level matters. That wasn't just a number, that was the line where the system said, stop. Below that price, paper selling would have triggered delivery failures, dealer bankruptcies, and cascading defaults. So the selling stopped, and the smartest money stepped aside. The premiums are about to tell the real story here. This is what happens next, and this is critical. The paper price can fall fast, but physical supply cannot magically appear. As soon as the dust settles, buyers who were shut out at $117 will return at $75. Hard. And dealers know it. That's why you're about to see something explosive. Premiums. Paper silver might say $75, but physical silver will not trade there. Expect premiums to spike, not by a few percent, by double digits. This is how the disconnect widens. The futures price stabilizes, while real metal becomes unobtainable. This is exactly how previous silver squeezes began, quietly, after the crash. Why intervention is now guaranteed. Remember the insolvent bank? That problem doesn't disappear. When a major institution blows up on a derivatives book, there are only two outcomes. A cascade of failures. A bailout. History tells us which one happens. A bailout means liquidity. Liquidity means printing. Printing means inflation. And inflation is gasoline on precious metals. So here's the paradox. The very action taken to stabilize the system will reignite the rally it tried to kill. That's why this crash failed. It was too late. The final piece. Why this was the last attack. Let's zoom out. This wasn't random. This wasn't emotional. This was coordinated. It was the final desperate attempt to break a 9-month bull market before physical scarcity became undeniable. They threw everything at it. Margin hikes, paper dumps, sentiment shock. And it still didn't work. Silver didn't roll over. The trend didn't break. And the biggest short covered, you don't get clearer confirmation than that. What this means for you, this is not about trading paper charts anymore. This is about positioning relative to reality. Paper silver is a promise. Promises can be margin called. Promises can be settled in cash. Promises can be broken. Physical silver is not a promise. It doesn't default. It doesn't go bankrupt. It doesn't care about margin requirements. That distinction just became everything. Monday will not be quiet. Expect volatility. Expect confusion. Expect headlines screaming dead bull market. But watch the details. Watch premiums. Watch dealer inventories. Watch whether silver can stay above the crash low, because if it does, and JPMorgan already told us it will, then the snapback will be fast and violent. Final thought. Every major bull market has one moment where fear peaks right before reality reasserts itself. January 30th was that moment. The manipulation didn't succeed. It revealed the cracks, and now the system has to live with them. This was not the end. This was the confirmation. If you want to stay ahead of what comes next, subscribe. Because what happens after a failed suppression attempt is never subtle.